Thank you for joining Market News with Rodney Lake. This is a regular program for the GW Investment Institute, where we talk about timely market topics. I'm Rodney Lake, the director of the GW Investment Institute. Let's get started. Welcome back to Market News with Rodney Lake. I'm your host, Rodney Lake. We're coming to you live, not really live, but from the Innovation Studios here in Duquesne Hall. Thank you to the Duquesne family. Much appreciated. All right, today the topic is Amazon. So we're going to be talking about Amazon, and we're going to look at the company through the GW Investment Institute framework, business management, price valuation, and balance sheet. So Amazon, AMZN is the ticker. Reminder, this is not financial advice. This is not investment advice. Hire a professional to do that. This is for educational purposes. So let's talk about Amazon. I'm sure all of you have heard about Amazon, and you might have things in your basket right now, and maybe you just ordered something with the one-click shopping. It's important, it's pervasive that maybe your front porch, if you have one, there's a box there, or downstairs in front of your building, there's a box there. This is pervasive. Lots of Amazon Prime subscribers, so you're talking 200 million now. And Amazon's business, let's tackle the B first. The business is really everywhere, and people have talked about sort of how important it is for them in their day-to-day life. And really, it started from an online bookseller, and it's really graduated into so many different things. And we're going to touch on a little bit of that. So it's gotten into new business, it's been able to innovate, and it's grown substantially over the years. So let's first talk about, what's the market cap of this business? So this is on the higher end. This is one of our large holdings at the Investment Institute, one of the reasons that I'm talking about it, but lots of people know Amazon. It's a $2 trillion company. We're in late September in 2024. It's a $2 trillion company. Obviously, this is an important company for lots of different people. It's an important company for the Investment Institute. But it's important for different reasons. As an investor, it has done very well for us, and it's done well for a lot of people over time. And as a business, this delivers sometimes everyday products to people's houses. And with 200 million subscribers in Amazon Prime, which was something that they thought of. It's ubiquitous in a certain way. But for the business, what do? It's online retail where it started, selling books, but then it became the everything store, selling everything. And one of the most significant parts of the business that they added, and the person who's now the CEO, Andy Jassy, really led the charge on Amazon Web Services. So they had all this excess service space that they could sell and figured out, maybe this is a business unto itself. And they did just that. I'm oversimplifying the whole setup for anybody that wants to do a deeper dive on that. That's a separate topic. But the Amazon Web Services really became the backbone for lots of other companies so that they didn't have to do something called on-prem or on-premise servers. So they could say, I'm going to rent time from Amazon, and they'll manage all this stuff in the cloud for me. And this service I'll pay for. And if you can have these great economies to scale, you can really offer that at a much lower price than you could do that on your own. It's more convenient, more reliable. Someone else manages it for you. You pay the fee, and Amazon does the rest of the work. And they built that business and have grown that business into a very substantial business. And for a long time, maybe even up to 7 years, they had a lead in that business where you didn't really have other people get into that business. But certainly you had people like now Microsoft with Azure really get in there, cloud with Google and Oracle as well. There's other competitors, but those are some of the really big competitors. But it took like 7 years for them to get there. So Amazon really had sort of a big lead here and really built out a ton of infrastructure. If you go out to Northern Virginia, there's lots of data centers out there, and some are Amazon's. And so the business, when you think about, how should we score this business? Parts of the business, online retailer, you're not really talking about a super high margin business, right? And so when you look at the gross margins, they're 48% for Amazon, which is pretty good. And the net margins, though, are lower at 7.5%. And so, maybe you think, there are definitely better businesses out there if you look only at the gross and net margins. We talked about NVIDIA before. We've talked about Microsoft before. They're better on both of those metrics. But Amazon has become a very important part of people's lives. And so really, they're willing to, use Amazon for a whole bunch of different things. And the profit margins are very different on the online retailer space versus the third party that they provide. So other sellers can sell on their platform versus AWS. AWS would be closer to like a Microsoft style business with Azure. And it's really providing a service that you can charge a premium for, versus competitors when you get specialized services. And you can have a much higher profit margin on that business than you can, let's say, on selling towels and all the shipping costs that are related to that as an example. But the blended gross margin here is 48%, which still makes it a very good business. And so when we think about Amazon as a business, you think, well, there are different parts of that business, and now they're in the video business with the distribution there. They've gotten into the football business, as an example, with Thursday Night Football. And so it's in a whole bunch of different things. Now, one concern you might have is that maybe they're in too many businesses now. Maybe they need to narrow. Maybe they need to figure out what they want to be when they grow up. But it seems to be working for them right now. They continue to grow the business. And when you talk about the revenue growth, you're not talking about these enormous numbers anymore as it grew, but you're talking about pretty steady, now $600 billion in June 30, 2024, and growing about 10 to 11% per year. Well, when you're growing 10% per year, that's a big number. Next year projected to be, or by the end of the year, rather, 635. And by next year, at the end of 2025, you're talking 700 billion. So those are big numbers. Even when you have modest growth rates, when the base is that big, you're talking about very big numbers. Now, when you look at the free cash flow, good, and certainly it has transformed over the years. And Amazon was burning cash for a long time, was being criticized if you were watching it grow from IPO until now, which is quite a long time, a couple decades. But when you look at where it is now, it's generating generated rather through the end of June here, this year, 2024, it generated $48 billion in free cash flow, which is not the same as Apple as an example, but it's a big number, and it certainly has transformed again over the past several years. Even in 2021, they were minus 14 billion in free cash flow. But they're plowing a lot of money back into the business too. So they're always trying to grow. They're always doing things. And so you look at CapEx for this past year, it's $60 billion. And so when you put these things together, Amazon still has some real room to grow. You would think, well, it's so big. How does it get any bigger? Well, it's plowing quite a lot of money, again, 60 billion back into investments in the business, that CapEx. And so that's a big number. That's a pretty big percentage of sales right now, of revenue, about 10%. And so that's meaningful. And you want a company to grow, and you're going to need to do that. So when you talk about the business, maybe you think, well, it's not quite as good if we score it from 1 to 10, 10 being the best, as Microsoft or NVIDIA right now, but it's an excellent business, and people depend on it for a variety of different things. So it has that moat around its business where it's sticky, you have loyal customers, and people maybe are not going to switch. They have Amazon Prime. Well, maybe I'm not going to switch to another provider, or maybe I'm just going to go ahead and order that on Amazon. And so maybe we give that business a 7 or 8. So now let's move on to management. So Jeff Bezos is the founder and CEO for a long time until recently, and really was the visionary behind the business. And given lots of credit, he left Wall Street, basically D.E. Shaw, to go out and build this business. Clearly a bright person with lots of talent and skill, and started very humbly on that desk, famously that's made out of a door, and packing books himself. And so really starting with the idea of how to delight the customer. And if you read the memos, they talk about day one at Amazon. I think that's important. And I think the culture that they've built, and it's up to management to build the culture, is a fantastic one for a company that can continue to grow at scale, because you have to really think about how do we continue to innovate on day one. AWS, an example of that. The Prime is an example of that. And so what can they do it from here? That's the big question, and certainly that's the open question that lots of people are asking. Obviously, the visionary has moved on from CEO, and Andy Jassy now is the CEO, and he's the one who led the charge on AWS, as we mentioned. And so certainly someone who's very familiar with the company, somebody who helped build an important enterprise within Amazon, is leading the company and has been now, and seems to be doing an excellent job. Amazon continues to grow, continues to function well. The challenge now will be for an analyst to understand is, can he replicate the same type of culture of innovation where they're gonna get the next AWS, they're gonna find the next Prime style idea. It not necessarily going to be Amazon Prime, but it's going to be something else where it's innovative, it's new, but plays on a theme. If you think about Amazon Prime, it's a little bit like Costco membership, right? You pay the fee for the opportunity to participate in these other categories. And so Costco membership is similar to that. So it wasn't necessarily a new idea by itself. However, when you couple it with the things that Amazon was doing, it's an innovative idea. expressed in their own unique way. And, kudos to the people there. Now, can Jassy do the same thing as Bezos and create that culture where that can happen? Now, they have very specific ways they run meetings, or Bezos did. I'm guessing that Jassy's running things similarly. But as analysts, we really have to pay attention to that. So you want to read those annual memos. You want to listen to the conference calls. You want to make sure that you feel like that the culture is similar to what, if you thought it was good, that it's similar to the way it was with Bezos. Do they have that room to innovate? Do they have the room to really think outside of the box and create these new things that, well, people think, well, why would people want to use our server time? Well, it turns out that they did, and really a lot, and it creates a whole nother business segment, and they had years to run with that. So that's a super important culture to keep, and to keep moving forward is not easy. And so really it's up to Jassy and the current team to do that. Obviously, they can check in with Bezos anytime that they need to, but it's really up to the current team, and Jassy is the CEO, to lead that charge, to make sure that the culture continues and that they have that innovation. So management team, I'm giving a high grade. I would say that they're an 8 or a 9 even at the moment, and they have done a fantastic job. Now, when we look at the price versus valuation, this is a great company right now, and it's a great business with a great management team. Or if you don't want to say great, you can say good. This is a good business with a good management team, or a great business with a good management team. I think right now you can say but either one of those things, and it can be accurate. And obviously that's whatever perspective you have on it. It's a $2 trillion company. And what's the multiple? So if you look at the forward multiple, it's at 33 times. The S&P is at 25 times. So that's really not that expensive. If you think about, well, I'm paying 25 times for the S&P and 33 times for the forward, looking at the end of the year in 24 for Amazon, I wouldn't call that a super duper premium or anything by any measure, but it's more expensive than the market. So what justifies that? 10% growth rate, maybe not, can't get too excited about that, but the big reinvestment in the business, along with a 10% growth rate, now with a 45% gross margin and hopefully improving over time, that maybe starts to justify that higher number. And if they can continue to grow that free cash flow, even better, which they have been able to do. So over the years, that's kind of bounced up and down, but now you're talking about free cash flow of nearly $50 billion at 48, and projected to go to 54 and 72 by the end of 2025. Those are much bigger numbers. And so if you think about, okay, well, are we willing to pay up for those earnings? It looks like obviously people are. And as investors at the investment institute, our students really have to think, okay, this company, we own it, should we continue to hold this company? Right now, it seems everyone thinks yes. Time will tell where our analysts come out on that. But as far as the valuation goes, is it justified at the moment at 33 times versus the 25 times for the S&P? I would say it's definitely there. And maybe this is not a 10 being the best, but maybe this is something closer to like a 6 or a 7. So it's not a fabulous valuation where it's a screaming buy and you would say like, oh my gosh, something happened and we should be backing up the truck and buying as much as possible at this valuation. But it's a valuation that seems fair at 33 times, again, versus the S&P at 25 times. This is something you're not going to, say, well, this is something ridiculous. So it's absolutely worth spending time to think about this. And it's absolutely worth thinking that, are we justified for this premium? But at the end of the day, it looks fair. I would say that it's fair. And for our analysts, they have to do that work as well. But again, if you comp it versus the S&P, it looks to be a fair valuation. So now let's move on to the balance sheet. So other tech giants have, sort of this bulletproof balance sheet that we've talked about before, this really rock solid foundation. Amazon is not in the same situation, let's say similar. So when you talk about cash and cash equivalents at June 30, you're talking almost 90 billion, but you have 150 billion in debt. So you have, net debt, 60 billion, let's say. So it's not that net cash position that makes us sleep at night with Apple and Microsoft and some of these other companies, but it's also, they have a big pile of cash. The debt seems manageable. And if you look at the interest coverage ratio, you're talking 11 times. And remember, interest coverage is EBIT, earnings before interest and taxes, over interest. So we're not necessarily super worried about that. Amazon has historically been a super cyclical business. So it's not like, we're too concerned. Earnings have been, variable sometimes, up and down a little bit, but not so cyclical like a commodity company as an example, but it's something that we have to be mindful of. And it's not something where, again, you can sleep at night with an Apple or a Microsoft balance sheet where you have net cash and you're really not worried. They do have some net debt, but not something where we should be overly concerned about. Interest coverage ratio at 11 times is something that I think we can live with, but it's something where we have to keep an eye on this. Is it something that should be alarming? No. Is it something that we should be watching? Yes. Again, about 90 billion in cash, about 150 billion in debt. So net debt in this case, not net cash, but net debt in this case of about 60. And so 60 billion. But, interest coverage ratio, again, EBIT over interest at 11 times and generating nearly 50 billion in cash. Access to the debt markets, nobody's that concerned about Amazon, and with rates lowering, that should be a good tailwind for them if they want to or need to refinance any of this $150 billion of debt. Now, the one thing I will mention on the debt side is the debt has grown. So you're talking about a 50% increase in the net debt with basically a similar amount of cash over the same time period. In 2020, you had 100 billion in net debt. Now you have, as of June 30, you have 150 billion. So this is, for our analysts, something that we definitely need to watch. So you've seen the debt increase by 50%, and the cash, though, has not really increased by as much. So if you look at what was it back at the end of 2020, it was 84 billion, and now it's 89 billion. So the net position has also changed pretty considerably. So in that time period, in 2020, they were on a net cash position by $15 billion. Now it's net debt by $60 billion. So it's not alarming, but as an analyst, it's definitely something that we need to watch. And it's something that has changed considerably over that 4-year period. And so as an analyst, we got to think, well, what's driving that? And you got to really dive into that. Now, debt has increased by 50%. Cash has really not increased by that much, and we went from a net cash to a net debt situation. Is that justified? It doesn't mean it's right or wrong right now. And again, we're not concerned we're not concerned about the interest coverage ratio. But when you have such a big move for such a large company and you increase the debt by 50%, it's something to take note of. It's something to investigate. It's something to do additional due diligence on. And our students will need to do that this semester to make sure, is Amazon, what are they doing with this additional debt? Making sure that it's responsible. When we talk about capital allocation, what can companies do with capital allocation? So, they can grow the company. There are two parts to that. That is acquisitions or growth by building new products in-house. That is dividends, which Amazon doesn't pay. That's share buybacks, and that's paying down debt. In this case, they have not been paying down debt. They're actually increasing the debt. So as capital allocators, we got to think about, that component, they're actually going the other way. They're actually increasing the amount of debt. And so what are they doing with that capital? It's increased by 50% over the last 4 years. Again, something that we should be paying attention to, something that we should be watching, not be overly concerned about, but we absolutely need to keep track of that. And our analysts will need to work on that. So what do you give the balance sheet? All that said, well, between the 1 and 10, 10 being the best again, that's probably something closer to like a 6 or a 7 right now. 6 might be a little low, but so you could go with the 7 or 7.5 if you wanted to really make them feel better. But it's definitely something to watch, and that's why I would probably even say a 6, because you want to put it in there as a score to say, hey, let's really watch this and make sure that we're comfortable with what's happening, because the trajectory here is not going the way we would like as equity investors. Remember, the largest risk for any company is going out of business. I don't think we're anywhere near that, but again, we want to make sure to keep an eye on this. So now let's just do a little bit from each of the categories for Amazon. Again, it's an important holding for the GW Investment Institute. The business, we would say that that's a 8 or a 9 or something in this category. And some of the things that we would say, what are the reasons for that? Well, look, everyone uses Amazon Prime. At least 200 million people are subscribers. And people have these boxes in front of their houses, in front of their buildings, down at the desk in their building, if that's the setup, every day. And these boxes are ubiquitous. They're trying to do now drone deliveries. And if people want something, they go on, they click, it's shipped. And Amazon has figured out a way to get it to them. And they have been relentless in the pursuit of delighting the customer. And the day one attitude, which is connected to the management, is fantastic. And they're really figuring out ways to entrench themselves in the life of people. And so when people think about, well, I'm going to order something, a lot of times it's straight to Amazon. Is it there? If it's there, and even sometimes now, okay, I hope I'm getting a better price, but how many times is everyone really checking? And I think Amazon does a reasonably good job of trying to get people a good price. But that said, you're integrating this into people's lifestyles. So think of another company like Apple, which we talked about, that's also ubiquitous in people's lifestyle, from holding a phone as the example. Amazon is there in another way, right? It's not through a phone necessarily, but it is through, hey, if I'm going to order something, it's likely going to be on Amazon. So if I want a product delivered to my house, whatever it happens to be, maybe the first check is Amazon, and maybe I buy it before I even check anything else, and it's already on the way to my house. So kudos to Amazon on the business side for entrenching themselves, for thinking of this type of how do we delight the customer? How do we get products out to the customers the fastest? Building their own delivery networks, building their own warehouses. These things are all super important on the execution of delighting the customer. So then the other segments, like AWS, thinking, outside of the box and building that into a entire business. And really that, long ago, 10 years plus, let's say, was not necessarily as important as it was now, as the world has grown into, and including artificial intelligence. This business of, running things off-prem or off-premises has become more and more important. Everything is in the cloud, including a lot of the AI functionality. And Amazon was early to that game with Amazon Web Services, led by Andy Jassy, which we'll move on to in a second for management. But that is a, segment crusher, right? They really killed that for, let's say, they had a 7-year lead, let's say, on a lot of people. But now you have other dominant players that are doing great in that business, Microsoft, Google, and Oracle as well. But they really built their enterprise. They certainly built the brand name for that business. A lot of people trust Amazon Web Services. And so it's a super important part of their business. One of the people who led that, or person who led that, Andy Jassy, is now CEO of Amazon. So when we talk about management, you had Jeff Bezos setting that culture, day one, innovation. Let's think of these new things like Prime, like AWS, and let's delight the customer. Let's provide video and all these other things. So the culture that has been set from Jeff Bezos and now Andy Jassy, I would rate high on management now, and their responsibility with the different metrics in the business have also been good. And so, business, you would say maybe that's an 8 or 9. When you talk about the management, you're probably talking about that's 7, 8, or 9, depending on, let's give Jassy some time to prove himself even further and make sure that you can make that transition between Bezos and Jassy. And really that day one culture is what you're looking as an analyst to think, can they keep that? Can they keep that culture? Can they have that day one outlook where, let's think of new things. Let's make sure, let's not say that, it's all been done and this is the way that we do it. Let's reconsider. Let's think from first principles and make sure that we're, delighting the customer with whatever the service or product that we're providing. And I think, again, the time will tell, but so far so good for the transition, and it's been some time. However, it's important when you talk about, when you transition from a founder, think Steve Jobs, to Tim Cook, what is that going to look like? Obviously, it worked out super well for Apple, and if you're an investor, which we were, for investors in Apple and for customers. And so, ideally, in this case, Jassy does a good job. As a reminder, Bezos is still involved. He's still the chair and co-founder of Amazon. So it's not that he's not involved at all. But when you look at Jassy, he's been a few years in the seat, and so time will continue to tell. But things have been going well so far. And again, it's not 3 days. It's more like 3 years. But it's still not the same as the founder. So we'll have to watch that closely. But you're still going to give a 7 or an 8, I think, on management. Now, balance sheet, we mentioned, they've moved up 50% over the past few years. So that's a little bit of a concern from a net cash position to a net debt position. So when you're talking about the balance sheet in 2020, you're 84, 85 billion in cash and 100 billion in debt. So your net cash, let's say 15 billion. And now, fast forward, you're at 89 billion in cash and 150 in debt. So a net position of debt of 60 billion. So that's not as comfortable. Interest coverage ratio is 11 times, again, EBIT over interest. So not alarming, again, but the trajectory is really something to check out. Why has, over this period, and by the way, this corresponds with when Jassy has taken over approximately, why now go from a net cash to a net debt position? Now, the another part of that to consider is, but free cash flow has gone up considerably. When you talk about 2020, it was $25 billion and even dipped negative in 21 and 22, and now it's positive 48, close to 50 in June 30. So that's the other side of that coin. So it's something to watch, but I'd still give the balance sheet probably a 6 right now, something to watch. Watch that trajectory. Where's that going? And then when we do price and valuation, again, we talk about this is probably a 6 or a 7. So we do, because you're trading at 33 times forward, and the market is at 25 times the S&P 500. So again, business, I would say 8 or 9. Management, you're talking 7, 8. Price valuation, you're look at maybe a 6, and the balance sheet probably a 6 or a 7. So pick your aggregate score here. So you're probably talking in the 7.5, 8 category right now, depending on how you weight each of those categories. But there is some things to watch for Amazon. Can Jassy continue the culture? Is something to continue to watch. He's been in charge for a few years. Let's check out what's happening with the balance sheet. This is for our analysts as we're owners of Amazon. And where do we think the business is going? Amazon Web Services has been a juggernaut for a long time. Can they continue to innovate? And really, that's up to the management team. But overall, a fantastic company. It's been a great portfolio company for us. Well, I'm sure many people will continue to use Amazon. But that's a wrap for this episode. We'll see you back on Market News with Rodney Lake. Tune in then. Thank you. Disclaimer: the content shared in the GW Investment Institute podcast is for informational and educational purposes only and should not be considered investment advice. The opinions expressed in this podcast are those of the host and guest and do not necessarily reflect the views of the GW Investment Institute or the George Washington University. Listeners should not act upon the information provided without seeking professional advice from a qualified financial advisor. Investing involves risks, including the loss of principal. The GW Investment Institute, the George Washington University, and the podcast hosts do not assume any responsibility for any investment decisions made based on the content of this podcast. Always conduct your own research and consult with a financial advisor before making any investment decisions.